Hello, welcome to the European Open briefing for Thursday, June the 1st. I'm Rafi Barajan, currency analyst at xm.com, and we're going to be looking at what's happening in the currency markets today. So we had more data out of China this morning, and it gave conflicting views about the state of China's economy, and it also hurt the Australian dollar, which had earlier risen sharply from solid data out of Australia, but of course Australia is also the Australian dollar is impacted as well by China, so that's why we saw the Aussie reverse lower. The yuan, on the other hand, is continuing to advance higher against the US dollar. It hit a fresh 6-month high earlier today. We also had the data out of Japan this morning, which were very positive, and this shows that Japan probably grew even better than expected in the first quarter, and is on track to grow strongly as well in the second quarter. The pound, on the other hand, isn't doing so well this morning, although yesterday it did actually manage to rebound quite sharply from a poll early in the day that showed that Conservatives could lose their majority in Parliament. We had another poll yesterday which gave a wider lead for the Conservatives. That helped the pound rebound, but this morning there was yet another poll, so we saw the pound slip back again. But as far as the US dollar is concerned, it's fairly muted, as with the markets await the non-farm payrolls report, which is due tomorrow. But let's start with the Australian dollar, because we can see that brief spike earlier today that came after the retail sales data out of Australia was much stronger than expected, but then soon after we had the cash-in PMI, manufacturing PMI out of China. That showed a surprise contraction in May. It came in at 49.6, and it contrasts with the official manufacturing PMI that was out yesterday, which showed an expansion. We saw the Aussie spike up to 0.7454 before dropping to a 2-week low of 0.7381. It's now back just about 0.74 level. In terms of data for Australia, they were fairly positive. First quarter capital expenditure figures were a little bit disappointing at 0.3% versus expectations of 0.8%, although we saw a sharp upward revision to the fourth quarter figures, and nevertheless this was also the first increase in business investment in 5 quarters for Australia. And as for retail sales, they jumped by 1% in April versus expectations of 0.3% increase, although house prices in Australia's big cities did fall in May for the first time in 1.5 years. So we do have a mixed bag of data there for Australia's economy, and although the main significant data here is the retail sales, given that they had been rather weak recently. Moving on to China now, we can see the yuan has been falling sharply since last week, and that follows the Moody's surprise rating downgrade for China's sovereign debt rating. The People's Bank of China is trying to deter speculators by pushing up the yuan. It's been setting higher midpoints, so that's why we're seeing that sharp appreciation for the yuan. The dollar has dropped below the 6.80 level for the first time since mid-November, and this comes despite conflicting data out of China. Yesterday we saw the official manufacturing PMI hold steady at 51.2, but the cash-in PMI, which focuses more on on smaller companies, it showed the manufacturing PMI drop to 49.6 from 50.3. Then that's below expectations of 50.1. Moving on to the US dollar now, we can see it's been rather steady this week. It briefly rose about 111 yen early today before slipping back just below it. We had the Fed's beige book yesterday, which failed to add anything new to the economic outlook for the US economy, and the lack of direction has led to the US Treasury yields drifting lower in recent days. We had San Francisco Fed President John Williams speaking once again, and he repeated his baseline view of 3 rate hikes in 2017. But he also didn't say that a fourth increase is possible if the economy did strengthen, although this is rather unlikely given the fairly moderate growth we've been seeing out of the US lately, and that's why the big focus now is on tomorrow's non-farm payrolls report. We've got the ADP employment report coming out today. That's the private survey ahead of the official data tomorrow, and if it comes in as expected or above expectations, it will probably reaffirm expectations that of a June rate hike by the Fed. But Japan, on the other hand, the data has been much stronger this quarter, the past quarter. Although, as far as the yen is concerned, didn't really see much of a reaction to the Japanese data. The Japanese manufacturing PMI rose to a 3-month high in May. It was revised up from the initial estimates of 52 to 53.1. Capital expenditure by Japanese businesses rose by 4.5% year-on-year in the first quarter. That points to the fact that we may see an upward revision to the first quarter GDP growth for Japan. And also there was more good news as corporate profits by Japanese firms rose to a record level in the first quarter, all of which points to a big boost for Japanese businesses by the improving global economic outlook, which is helping Japanese exporters. Let's move on to the pound now, because we can see the pound is basically moving up and down every time there's a new poll out. Yesterday we had that YouGov poll that showed the Conservatives may lose their parliamentary majority. That led to that sell-off, sending the pound below 1.28. It later rebounded from another poll that showed a 15-point lead. That was a comfortable lead there. But YouGov published another poll late yesterday, which put the Conservatives with just a 3-point lead ahead of Labour. And that, once again, we can see it pushed sterling back below 1.29. Although it's not doing too badly, it's around 1.2850. That's still a fairly healthy level for sterling compared to its recent lows. But again, we are seeing rising concerns about whether or not Theresa May will manage to win a majority, enough of a majority or even any majority at next week's election. Looking ahead to later in the day, we've got the UK manufacturing PMI. That will be important for sterling. But before we go, let's have a look at oil prices, because yesterday we had the API inventory numbers. It showed US crude stocks fell by 8.7 million versus expectations of a 2.5 million barrel drop in the week to May the 26th. So that helped WTI crude oil bounce from a 2-week low of 47.73 to around the $49 level. It also helped the Canadian dollar, which had actually dropped to 1-week low of 1.3522 yesterday. It's currently trading around 1.3480. We did have a very good GDP data numbers out of Canada. Annualized growth was 3.7% in the first quarter, and this raised expectations that we may see a Bank of Canada rate hike later this year. And looking at today's economic calendar, we can see it's a very busy day in terms of data. We also had terms of trade data for New Zealand, although the Kiwi was actually not much impacted from that positive export figures there. Coming up later in the day, we're going to have the UK manufacturing PMI. We already had the final reading for the Eurozone manufacturing PMI, which was unchanged at 57.0. We're going to have the ADP employment numbers for the US, as well as the weekly jobless claims, as well as the ISM manufacturing PMI. That's it from me. Thank you very much for watching, and have a great day.